The Bank of England is expected to cut rates next week, but the economic environment seems more unpredictable than ever. This is Macro Matters, and we're talking the Bank of England. UK policymakers are expected to deliver a rate cut on Thursday, but they're unlikely to all agree. Some economists think more aggressive action is needed to boost Britain's slowing job market. Others think inflation is still too persistent, and the Trump administration's upending of the global trade picture makes it difficult to forecast. Liz Martins is HSBC's senior UK economist. Liz, are you expecting a split in opinion among the committee members?
We are indeed. And as you say, the economic picture just makes that split kind of almost inevitable. Some people are much more worried about inflation. Some people are much more worried about growth in the jobs market. So we saw that split back in May, the last time they cut. Some people wanted a half-point cut, some a quarter, some no change at all. And we think that will happen again, except we think the split this time will be slightly more hawkish. And that's one more vote for no change. We think that will be Megan Green joining Catherine Mann and Hugh Pill. 4 for a quarter and 2 for a half-point cut. So yes, a big split of opinions, but a shift very slightly towards no change.
What's the bigger risk, though, do you think, that they cut too quickly or not quickly enough?
It's really tough, isn't it? Because, there's real concerns on both sides. We've started to see unemployment rise. We're seeing vacancies well down. We're seeing wage growth slow. So all of that would speak to the need for a cut. The other thing I think that argues for cutting rates is the continued high savings rate, high savings intentions, which means that even where people are getting a bit better off in terms of real incomes, people aren't spending that money. They're not going out and spending it, they're keeping it in the bank. All of that speaks to the need for a cut to get this economy going again. On the other hand, the BOE's primary target is to get inflation down to 2%. And, it may forecast in this update that inflation's going as high as 3.8, maybe even 4%, double the target. And when your first task is to reduce inflation, I think that has to be the priority. And that's why I think, the vote split will go a little bit in a hawkish direction. And the messaging might be a bit cautious too. It might be, we've got rates down from 5.25 down to 4%, but now we really need to see some more evidence of inflation coming back under control before we do any more.
The average prediction from economists that Reuters polled was 4 quarter-point cuts in the next year, including next week. What's yours?
We've got 5, actually. So we do think we will get all the way down to 3% by August 2026. So that's slightly contradictory to what I just said about the hawkish messaging. But essentially what that encompasses is a view that we are in an inflation hump. The BOE rightly will need to see more evidence before they continue, but we think they will see that evidence. And I think the slowing, the sort of sluggish growth, the poor jobs market, that will produce the evidence of falling inflation that they need to see. And this should be a temporary one-off kind of hump in inflation before we get lots more readings down in the 2s next year rather than the 3s.
What about how the global trade picture might affect prices in Britain? The Trump administration has announced a new raft of tariffs on countries around the world. Britain, of course, has a 10% rate, but what will the fallout be?
Yeah, I think there's a number of ways in which this affects us. The direct impact is actually quite small, of course. The UK economy is not a big goods exporter. We're not dependent on selling physical goods into the US by any means. And of course, we've got the lowest tariff rate of anyone anywhere in the deal. So the direct effect on our exports is relatively small. But broadly, the consensus, even among the hawks on the Monetary Policy Committee, is that for inflation, this should be disinflationary because it should slow demand, in the global economy more broadly. But also you get this trade diversion effect. So countries that were selling lots of goods into the US and now face kind of barriers into that, those countries are now going to be looking for a home to sell those goods, and there's going to be a surplus, and that can be disinflationary, particularly in the goods space. So broadly speaking, look, things are a little bit clearer as of today. We know what the final tariff rates will be. There's still a huge increase. I know the markets have kind of shrugged off the impact compared to the turmoil in April, but there is still a huge increase in tariff rates and goods getting sold into the US. And as the year progresses, I think we'll see more inflation in the US and perhaps a bit less everywhere else.
That was Liz Martins of HSBC. Don't forget you can watch more videos on Reuters.com.